Good morning, everyone. Welcome to Ainsley News. It's Tuesday, the 25th of January. We're talking crypto, of course, today. Are we headed into a crypto bear market? One that's even more deeper than what's just happened. As Bitcoin prices are cut in half from their all-time high, the market experiences a large on-chain capitulation event with 2.5 billion in net realized losses. So, are we heading into a bear market? Bitcoin market has had another challenging week, prices declining from weekly open of $43,413 down to a new local low of $34,407. This puts the total drawdown relative to the November all-time high at 49.9%. With the bulls now firmly on the back foot, such a heavy drawdown is likely to change investor perceptions and sentiment at a macro scale. Drawdowns of this magnitude are markedly higher than 20 to 40% range seen in the 2017 and 20 to 21 bull cycle corrections. The net unrealized profit loss, or the NUPL metric, presents the overall market profitability as a proportion of the market cap. NUPL is currently trading at 0.325, which indicates that an equivalent to 32.5% of the Bitcoin market cap is held as an unrealized profit. This comes in stark contrast to the much higher profitability values of the 0.75 point set in March and the 0.68 set in October last year. There's several indications from this. Considering previous cycles, such low profitability is typical in the early to mid phase of the bear market. One could be reasonably arguing that a bear market started in May 2021 based on this observation. Unlike 2013 and 2017 bull markets, aggregate network profitability actually declined between the all-time highs set through March, April, and October, November tops. This is a result of coins being distributed at the highs, lifting the overall market cost basis and thus creating a bearish divergence in this indicator. Another measure of network profitability is the MVRV ratio, presented as a Z-score tracking standard deviations away from the long-term mean. MVRV ratio is calculated as the market cap divided by the realized cap and is a useful tool for identifying periods of high and poor investor profitability. With the current MVRVZ reading of 0.85, the market is well within territory visited in bearish markets, and bearish divergence is noted, similar to the NUPL metric we talked about. Generally speaking, such low values of MVRVZ are reached in the following cases. Steep corrections in bull markets are usually followed by a reversal to new highs. Early bear markets after blow-off tops, as the market panics, investors capitulate and often precedes a strong relief bounce. Mid to late bear markets, where the MVRVZ trades below 0.85, signifying a period of very poor profitability, low sentiment, and sustained investor losses. By this metric, the bulls either need to step up in a big way, else the probabilities favour the bears. That said, a relief bounce in the near term is probable if history is to act as a guide. We've now established that numerous signals point to a macro scale bear trend in play. With this as prelude, we now turn to investor spending patterns, where the week's theme was investors capitulating significant losses on chain. The net realized profit loss metric tracks the amount of market-wide profit minus loss realized by on-chain spending. This provides a measure of daily capital flowing in and out of the Bitcoin network. As the market traded down to weekly lows on Saturday, over 2.5 billion in net losses were realized, with investors spending coins held at a loss. This marks the largest capitulation event of this drawdown and almost matches the $2.61 billion net loss from May 2021. Over the last 7-day period, the total sum of realized losses has now exceeded 7.57 billion. Again, in a similar ballpark to major capitulation events over the past 12 months. It can be seen in charts that we show you today. The large realized loss events typically correlate with local market lows. As investors who bought the recent top capitulate, the stronger hands and traders drive the market into a relief rally. Note, however, that the current drawdown has sustained and elevated losses since early November, indicating this correction has been particularly painful. Looking at the cross-section of investors who realize the majority of these losses, we can determine that it is largely short-term holders. Coins are considered to be owned by STHs when they're younger than 155 days old and are statistically more likely to be spent in the face of volatility. Short-term holder SOPR metrics have accelerated downwards this week after finding resistance at a value of 1.0 through this drawdown. Psychologically, this suggests that recent buyers are taking exits at or below their cost basis to cash out, creating sell-side pressure and resistance. Lower values indicate heavier losses are taken by STHs, who in this instance are disproportionately top buyers. Assessing the supply dynamics, we can see that short-term holders are currently in possession of approximately 18.3% of the coin supply. Almost the entire short-term holder supply is underwater. This again creates a psychological barrier whereby the coins that are already the most likely to be spent and sold now holding an unrealized loss, which further increases the chances of a sale. Interestingly, STH supply remains near multi-year lows, which is indicative of the counterpart, the long-term holders who appear impressively unfazed by such a severe drawdown. The proportion of LTH supply has returned to a modest uptrend, which indicates a general unwillingness for this cohort to liquidate. Faced with what looks like a bear market, long-term holding coins are firmly in cold storage, a strong sign for the long-term future of BTC. Like STHs, the long-term cohort is not without financial pain, with 6.04% of the 81.7 supply yield by long-term holders falling into an unrealized loss this week. This is the highest volume of long-term holders' supply held at a loss since the March 2020 sell-off. Over 59.3% of the circulating supply has now been dormant for over 1 year, increasing by 5.8% of the circulating supply in the last 3 months. Those coins reflect those moved on-chain between 2020 in October and Jan 2021 during the early and more exciting phase of the bull cycle. Whilst a rising and a large proportion of the mature coins is generally considered constructive, it once again bears similarities to a bear market, a time when only the hodlers and patient accumulators remain. Bear markets are hard to define in Bitcoin, as traditional 20% drawdown metric would trigger a bear almost every second Tuesday, given the volatility. Thus, we look to investor psychology and profitability as a gauge of likely and actualized sell-side activity. This past week has seen significant realized losses, a steep drawdown and a return to hodler-led accumulation, and top buyers taking any opportunity to get their money back. The crypto market also hasn't been shielded from the broader market sell-off. Considering the remaining LTH support, once confidence is restored to the market should easily find a bottom to work out of. Yes, tumultuous times, especially in BTC, but across the board, as we're seeing. As we say, is it a good time to buy? Classic examples of buy when it's low and sell when it's high would suggest grab a little bit at least, but that's completely at your discretion. Hope you're enjoying this news. Jump over to ainsleywealth.com.au if you are looking to buy this dip, ainsleyBullion.com.au for all things physical, and goldsilverstandard.com for our own crypto built and backed by real gold and silver. Enjoy Tuesday, everybody. We'll be back tomorrow for more physical bullion news.